You ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money.
When talking about great names in the investment world, Peter Lynch has to be one of them. Why? He managed the Fidelity Magellan Fund for a good 13 years, lifting the asset base from just $20 million to well over $13 billion by the time he retired. That's the kind of growth that only comes from a genius. Consider this: if you happen to have invested $10,000 with him, your investment would have grown to a massive $280,000 by the time he retired. If you wish to mirror such success, I suggest you take Peter Lynch's investing rules that I'm about to show you very seriously. It's hard for any investor to achieve a 29% gain in a single year, and averaging that over many years hardly happens. Fortunately, Mr. Lynch hasn't kept his investing thoughts to himself. Stick with me for the next 10 minutes or so as we highlight the top 10 Peter Lynch investing rules that can help you beat Wall Street. But before I begin, in the comments below, typing Lynch or Buffett, which investor do you look up to the most? Now let's get it on. If you want to be a savvy investor, follow these 10 Peter Lynch investing rules. Number 1. In the stock market, the most important organ is the stomach, not the brain. Peter Lynch says that those who don't expect volatility and can't handle it should look elsewhere to build wealth. Although there are a few places where you can build wealth over the long run as effectively as in stocks. Lynch added, "You've got to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do I do if it goes down 20%? Am I going to sell? Am I going to get out? If that's your answer, you should consider reducing your stock holdings today." Emotions can be a real performance killer if market drops get you selling out in a panic, or market surges have you greedily snapping up overvalued shares. The best investors will do the opposite. As Warren Buffett has quipped, it's best to be greedy when others are afraid, and afraid when others are greedy. Number 2. Buy what you understand. It's also important to only invest in the stock of companies you understand, and some companies are far easier to understand than others. It's not enough to understand, for example, that a certain company makes cancer-fighting drugs. You need to know what drugs the company has on the market and how well they're selling, what drugs are in its pipeline, and how close to market they are, considering that many drugs never clear clinical trials well enough to make it to market. You need to know about competitors' drugs on the market and in pipelines too. Companies that make and sell soda, candies, or shoes are simpler. Aim to be very familiar with the companies and industries you invest in. Lynch has explained that if you're prepared to invest in a company, then you want to be able to explain why in simple language that a 5th grader could understand, and quickly enough so the 5th grader won't get bored. Number 3. Do not be intimidated. It's easy to let stock investing intimidate you. After all, there's some math involved, but much of the math isn't that complicated. The price-to-earning ratio, for example, is a mere ratio. The stock's current price divided by its annual earnings per share. A dividend yield is simply the stock's annual dividend, often 4 quarters worth of payments divided by its current stock price. As Lynch has noted, everyone has the brain power to follow the stock market. If you made it through 5th grade math, you can do it. Number 4. Do your research. Many people buy stocks only after reading a little about them in an article, or worse, after just hearing a little from a friend or acquaintance. For best results, you need to pore over a company's financial statements, checking to see how much cash and debt it has, how fat its profit margins are, whether its revenue and earnings are growing, and by how much, and other numbers like that. Ideally, collect lots of ideas of promising companies and study them to see which remain really promising to you. Per Peter Lynch, the person that turns over the most rocks wins the game. And that's always been my philosophy. He also said, never invest in a company before you've done the homework on the company's earning prospects, financial condition, competitive position, plans for expansion, and so forth. Number 5. Understand that there are gray areas. Lynch said, investing in stocks is an art, not a science, and people who've been trained to rigidly quantify everything have a big disadvantage. That's important because investing isn't solely about numbers and math. Consider, for example, a classic disaster story. The long-term capital management hedge fund was literally run by several Nobel Prize winners. And yet, it imploded in 1998 and had to be bailed out with several $billion. Investing in individual stocks involves making educated estimates of how companies will perform. When several smart and talented people study the same company, they may reasonably come up with different estimates and viewpoints. Tesla is a good example, as it has ardent supporters and detractors. Number 6. Look behind the obvious. Another bit of Peter Lynch gold is this. During the gold rush, most would-be miners lost money, but people who sold them picks, shovels, tents, and blue jeans made a nice profit. Today, you can look for non-internet companies that indirectly benefit from internet traffic. Package delivery is an obvious example, or you can invest in manufacturers of switches and related gizmos that keep traffic moving. It's easy to see promising stock ideas, but many others have often already noticed them, driving up their share prices. Many times, though, many other companies are working in the shadows, supporting those companies. For example, Apple has been wildly successful, but it's not succeeding alone. It has many suppliers of parts for its hardware, such as Universal Display. If you're bullish on e-commerce, you might look into companies doing a lot of delivering, such as FedEx or UPS, as well as various retailers. You might look into equipment makers such as Middleby or Hotpoint for the restaurant industry. Number 7. Consider mutual funds. All of this might have you realizing that studying companies is just not something you can do, either now or ever. You may not have the time, the interest, or the skills to do it, or even learn about it right now. That's okay, because there's a solid alternative: mutual funds. Remember, after all, that it was a mutual fund Magellan that sported the amazing 29% annual return. That said, though, remember that such an amazing record is exceedingly rare and rather impossible to find before it happens. For most of us, it's probably best to opt for low-fee broad market index funds, such as those based on the S&P 500. They've actually outperformed most other stock mutual funds over long periods. As Peter Lynch has noted, mutual funds are the perfect solution for people who want to own stocks without doing their own research. Number 8. Expect losses. It's also important to expect losses when investing. They'll happen no matter how good or bad an investor you are, and no matter whether you're investing in individual stocks, managed stocks, mutual funds, or index funds. Even Warren Buffett has made some regrettable moves, as has Peter Lynch, who said, "In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Number 9. Patience pays. Last but not least, be patient, because most great wealth from the stock market is built over decades by rich and famous folks such as Buffett and Peter Lynch, and by ordinary people who got rich investing too. As Peter Lynch has said, time is on your side when you own shares of superior companies. Number 10. Long shots almost always miss the mark. According to Lynch, it can be tempting to buy cheap shares in weak companies due to excessive valuations in today's bull market. Waiting for lower prices among stronger businesses could provide more appealing risk or reward opportunities. The bull market may encourage investors to buy companies with weak finances or relatively challenging outlooks. They may reason that such businesses have the potential to deliver better than expected results due to the economy's bright near-term prospects. Moreover, such stocks may trade at a discount to their peers and could therefore offer greater capital growth potential, according to some investors. However, an approach that aims to buy lower quality companies because they're cheap could backfire over the long run. Investors may fail to appreciate the risk they present, since they're currently operating within a relatively strong macroeconomic background. When the next recession occurs, weaker companies may be less able to survive than their industry rivals. As such, their share prices may be negatively impacted to a greater extent than their stronger peers. This prospect may not currently be factored into their share prices due to excessive optimism prompted by the stock market's recent rise. Investors' bullishness may be overlooking their weaknesses in favor of upbeat financial prospects. Therefore, while some stocks may be cheaper than sector peers, they could still trade significantly above intrinsic value. This may mean they offer little or no margin of safety should the future performance be less attractive than many investors forecast. Instead of purchasing long shots, Lynch sought to unearth companies with solid fundamentals. For example, he would continually search for firms with good financial positions, clear competitive advantages, and upbeat growth prospects. When such companies were available at a fair price, he would buy them. Crucially, if they were not, Lynch was comfortable waiting for them to come down in price. As I wind up, I want to leave you with one of my best Peter Lynch quotes. Owning stock is like having children. Don't get involved with more than you can handle. And that's it from us today. Which of these investing rules do you practice? Let us know in the comments below.